Hello, fellow Rebel Capitals. Hope you're well. I am back with my good friend Chris MacIntosh, and we were just talking offline about some very interesting things. I said, you know what, Chris, we got to hit the record button and allow people to come into this conversation and what you're talking about as far as this capital rotation. So, can you just kind of summarize the last 10-minute conversation that we had for the viewers?
Yeah, sure. Welcome everyone. So what we what we began this conversation with was overvaluation and capital concentration. So we were talking about Nvidia, generally anything AI based, and we're seeing a plethora of the types of ingredients that one sees at or close to a peak. So we don't know when this peak is, and we don't know exactly the timing of it. But what is absolutely evident is that this is an area to stay well away from
Right.
if you are invested in it. The problem, of course, with this is that many people are invested in it without knowing that they're invested into it. And what I mean by that is the vast majority of mutual funds that exist out there are along the S&P or the NASDAQ. And now we have such a concentration within the NASDAQ and within the S&P that is concentrated on the Mag 7 and in particular in Nvidia, that you can't escape the concentration if you are in basically most of the broad US equity-based mutual funds or ETFs. So that of course also accelerates this concentration of capital. So that was the first point of discussion. The second is that while this has all been transpiring, we've had gold outperforming for a solid 2 years now. That is a canary in the gold mine, so to speak, in terms of what I believe is a capital rotation. Okay. And so we go through these periods. We had it in the 30s, in the 80s, where you have major events transpiring. Typically, it's broad equity markets get cut in half or something to that degree. And at the same time, you have the capital rotates, and it rotates into other asset classes. The other asset classes in this instance, in our belief, is going to be precious metals, commodities, and things of that nature. So these are all of the topics that, for anybody that's been on Rebel Capitalist Pro for some time will be quite familiar with the types of things that we hunt for and look for. But we are seeing a lot of those things transpiring, and certainly in our portfolio, it's been a slog. I'll be honest with you. You're fighting this battle of enormous pools of capital pouring into things like Nvidia and the Mag 7, just pushing it higher and higher despite any of the economic indicators, and that's a tough benchmark to be working against. Despite that, we managed to beat it, and I think we've beaten it by basically taking extremely lower risk. And what I mean by that is we're buying things that are dirt cheap, bottomed out, and hated. Greek equities. For the last 2 years, as an example, I could give a number of them. But so I think we are. To summarize, I think we are already in a capital rotation type phase. We're seeing the ingredients of that. The first and the foremost of that tends to be gold. And then what we're watching now is that gold equities are now playing catch up. That tends to be a later stage mover. And then, of course, we have silver and platinum. Silver's basically just gone up like it took a shot of Viagra, and off it's gone. And platinum now is moving in concert. These are things that we've been talking about and invested into as well.
I think the question that I hear all the time, Chris, is has it run too far? And I want to back up a little bit, because when you were saying that you wouldn't want to touch Nvidia with a 10-foot pole or the S&P 500, it's not that it can't go up. I mean, it could double from here. Nobody really knows. But what you're saying there is the risk reward doesn't make sense. You're not saying it's not going to go up. You're saying that the risk reward doesn't make sense. So you, as a capital allocator, you're trying to say, okay, well, where does the risk reward make a little bit better sense? And so you gave the example of the Greek stock market. Most people, and I just read your most recent letter in Rebel Capitalist Pro, so I know this right off the top of my head. But most people don't realize the Greek stock market has outperformed the NASDAQ, correct me if I'm wrong, over the last 5 years. Am I getting that right? I mean,
Yeah.
no one
So
would have that on their
and
bingo card, but
and
you've been
here's the
invested in the Greek stock market, because it just made a little bit better risk reward. Your downside was less, and it turned out it actually outperformed the Nasdaq.
again, it's to that point of it's not that the S&P wouldn't go up any higher, it's that the risk to investing in it is asymmetrically against you.
There you go.
In
Yep,
that
yep,
that the valuations do not support the price, you know. And so when you, as a contrast, if you look at Greek equities, even today, they aren't particularly expensive, despite the fact that we're up a lot. We haven't sold that position. At some point, we'll offload it. But nevertheless, it's a matter of risk. And so the risk to having something dropping substantially is always exacerbated and is higher when your valuations are out of sync with the underlying market, and that's
yeah, but
essentially
right
what we
now,
have in
Chris,
the S&P.
right now, I think people are really concerned. Gold investors are concerned that maybe this is run too far, and that maybe the juniors or the miners, I mean, they're up what, 120%, just looking at the ETFs. So maybe they've run too far, and maybe they're getting to the point where they're like Nvidia ish or
No,
S&P 500 ish. And but I hear that a lot in the comments, and I think it's a valid concern when you see how much they've gone up. So what would your rebuttal be for that, and how are you playing gold and the miners right
sure.
now?
Well, there's two answers to this. The first is that as human beings, it's quite easy for us to look at something from a short-term basis. If we are to look at, say, something like GDX over a year time frame, a 6-month time frame, even a 2-year time frame, one could make that judgment that, oh, shit, this has gone up a lot and
Right.
potentially now exhibits more risk. That's without looking at earning power or anything else like that. I would suggest to look at, say, a 10, 20-year chart. That'll put things into a much, much stronger context. And I think the answer will be quite evident that, oh, this is bottomed out and it's basically an uptick. What you're looking at from that long-term 20-year chart is it's an uptick. The
Mm,
other thing is just the value. So ultimately, like the total of any assets, fundamentals constitute its earnings power, which is in turn its source of value. That's value.
right.
So when, and you could take something like Nvidia. Okay, what is its ultimate value? It's its earning power. What is the value of mining companies? It's their earning power. And so on those metrics, I would certainly be buying gold equities well over something like Nvidia. So I think that's important to look at that ultimate value behind these companies and what is their earning power. And the earning power on gold equities is also predicated by the price of gold itself. So you could argue one needs to have some sort of a view as to that. You know, if, in other words, if gold was massively overvalued for whatever reason and should come down, then you might not want to be buying into the companies, which would be decimated or anything like that from a downtick in the underlying commodity.
Yeah,
But that
Chris.
those sorts of things you start seeing at the end of bull cycles. You know, we had it in 2012, 2014 in the energy space,
Yeah.
where you had your earnings power, and they were quite good, but they were predicated on the price of oil going ever higher often. So those are just some of the other components that one needs to look at, especially when you're pricing equities that are related to commodities. You could do the same thing, I suppose, with Nvidia, and you could say, well, what are the chips? We saw the Larry Ellison deal where he's going to be, and I look at this and this is ridiculous because they don't have the chips and he doesn't have the money. Like this is all just it's
Yeah,
narrative
it's
building
like
that adds.
Saudi Arabia telling Trump they're gonna invest 100 trillion in the United States in the next 2 years or whatever. It's like, okay, what's your GDP again? It's 50 billion? Oh, alright,
Yeah,
well, great. That sounds awesome.
yeah, and it's shocking to me that the market just responds and goes yippee,
Yeah.
which
Yeah. Hey,
which
I've got a good trivia question for you. I know this because I just talked about it on a video. What company replaced Enron in 2001 in the S&P 500?
oh gosh, in 2001, I don't know. Tell me.
In NVIDIA.
Was it that far back? Wow.
as NVIDIA. So not that that's a sign or anything, but if it turns out, it just
That
proves that we're living in a simulation right now, and whoever is controlling this simulation, they've at the very least got a sense of humor or maybe a sense of irony.
well, it
But
I mean,
go
we
ahead, go
were
ahead.
talking offline, right? I mean, there's just so many signs. This is just to the point of risk, folks. There are so many signs, there are so many ingredients that go into a bubble. Now, when capital chases ideas or stocks or anything else like that, and it goes up a lot, it always attracts fraud. You always get fraud, right? It's flies to shit. The fraudsters will look at that as an opportunity. And so I'm watching that sort of stuff. There was a particular company, I can't recall the name now, where you had some founding husband and wife team that came out. They raised $150 million, and they have like no experience, nothing. This is just an absolute clear fraud. But the only time that you are going to be able to go out with no real credentials, just a story, and raise the kind of money, like $150 million is a lot of money, especially for like a startup. The only time you ever get to do that is when you have this egregious spending in an idea. We saw it in the
Right.
dot-com era, and sometimes it's not a fraud. Sometimes it's just a stupid idea that people throw too much money at. The pets.com type stuff. People laugh about it, but it wasn't necessarily a fraud. It was just a dumb idea that you look back and we go, what were people thinking? But despite that, you definitely get the frauds. And I'm just watching that almost on a daily basis taking place now. And that's the risk side of things. The question then is, okay, if that is risk, then you need to be away from the risk. You need to get yourself out of the risk. And for many people, like I said, they're not aware that they're even at risk. And they're not aware because they're taking their monthly pension stipend
Right, right.
or that goes into the pension fund, and it just gets deployed, and they don't really know where it's going. But I can tell you where it's going. It's going to mutual funds and ETFs, of which many of them are invested into some version of the Mag 7. They were invested into the S&P or the Nasdaq, or they're invested into, gosh, I saw this, I can't remember, it was on
Chris,
Twitter. Someone
I'll
did a
bet
breakdown of all the ETFs and the mutual funds, and how similar they were, and like the correlation. So you could have like dozens of these, and they name them different things, right?
Mhm.
The blah 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 growth fund, the George Gammon growth fund, and you looked at them and they were only like a few percentage points off of the S&P 500.
Right, right.
So you were basically buying the S&P 500. You were just paying another 85 bips to some quote unquote money manager who's just a marketing guy, and all he's doing is really just putting into the spoos, but he's just changing it slightly so that the regulators don't go, oh, you're just selling the spoos, and
Yeah.
you.
But I
So
don't even think that honestly, most retail investor and not even investors, just the average Joe and Jane out there that's doing exactly what you're saying because Dave Ramsey told them that that's smart and just taking 10% of their paycheck and it just goes directly into an S&P index fund every single month. I'll bet you they could listen to a conversation that we're having about Nvidia and they'd be like, "Oh, well, I don't care. It doesn't matter. Nvidia could go down by 99% and it won't affect me because I own an S&P index fund." And
Mhm.
not even knowing that Nvidia is in the S&P 500 and not even knowing the degree to which Nvidia or the Mag 7 impact in the AI bubble impact the S&P 500 and therefore their portfolio. I don't even know that the average person can connect those dots.
Which is the ingredients that are necessary actually for these capital rotations that transpire.
Right.
You literally have to have that, both from the standpoint of having equities continue to go higher, i.e., send my check every month in, and it just keeps going into these passive capital flows. I mean, Michael Green's talked about this, right?
Yeah.
These passive capital flows, which increase capital concentration. And the more they increase capital concentration, the more it drives that very capital concentration in terms of the way that the algorithms work.
Mhm.
And so, like, you don't know when this is going to burst, but it's absolutely unsustainable. We know that it's unsustainable. In fact, my buddy Cuppy wrote an excellent piece on just the math of why AI basically cannot work.
Yeah,
And
I mean,
and
I just did a video, and just to keep it super simple for people, the way I described it and the actual math there was I took a quote from Sam Altman when he's saying that AI, or excuse me, OpenAI needs to invest like $1 trillion a year into infrastructure over the next 3 years. And then I went and looked at their annual revenue, and their annual revenue is like 12 billion. So I'm like,
it's nothing.
wait a minute here. And by the way, AI as it is right now is just a total commodity. Like there's no allegiance that people have to OpenAI compared to Gemini, compared to whatever else,
Claude,
Claude, or
Perplexity.
yeah, I
Yeah.
mean, it's just a race to the bottom as far as the subscription price they charge. So the analogy I used is it's like a kid going into college right now that wants to study engineering because at the end of the college journey, they can get a job, let's say making $100,000 a year, but they're paying $1 billion for their college education. That's
Hmm.
exactly what's happening right now. So
Hmm.
would you pay $1 billion in order to have a degree that allows you to make $100,000 a year? The answer is obviously no, but that's exactly what OpenAI is doing. They're saying we need to spend $3 trillion so we can make, $1 billion a year. $1 billion a year sounds like a lot, and it's a lot more revenue than pets.com was making until you zoom out and say, wait a minute, they're spending $1 trillion a year.
This is the global crossing. Remember global crossing?
No, what was that?
So there was in the whole .com era. In fact, the reason that you and I are talking for essentially free now is down to global crossing. So global crossing was, what was it, 97, I think it was. These are the guys that laid all the fiber optics and the cables
Oh, right.
under the ocean, to which allowed for the internet to be what it is today. And the because it was such an incredibly expensive thing to do, right? I actually make the analogy with global crossing with the channel. I'll get into that
Mm,
as a separate topic, but it's the same metric. You have this extremely expensive capex that's required to bring something into fruition, and massive hype behind it, which to some degree we needed this massive bubble in global crossing and in internet related things in order for us to actually now today benefit from it, and we needed it to crash too. So what happened with global crossing, tons of money went into this company. It was never going to be profitable. There was never going to be any payback, much like you're just talking about with Sam Altman and AI, open AI.
mhm.
And then what happened was all of those cables that got laid, which were egregiously expensive, the company collapsed. So your debt holders became equity holders, and the assets then got picked up for cents on the dollar. Now, if you and I picked up these fiber optic cables, for example, for cents on the dollar, we can then now offer
Yeah.
Skype, say, and all these things for very low, because we don't have any major capex,
Yeah,
right?
the math
we,
works.
we bought it for 10 cents. We're like, well, I don't care if it's been,
Yeah.
I know you spent $1 billion, but it's like, we didn't. So it's not our problem. And so that's essentially what happened with global
Yeah,
crossing.
the
And
problem
that's,
though the problem though, Chris, is now you have to relay cables every year because it's not like those GPUs that they
yeah,
buy
because
for
these
$1 trillion. The
yeah,
CapEx cycle, my point is the CapEx cycle, to put it in professional terms, is a lot shorter. So it's like you got to lay down those wires, those global crossing wires to the Atlantic Ocean. You've got to do that once a year, not once every 50 years or whatever it is.
this,
And that's a whole different dynamic right
yeah.
there.
Look, all these, the GPUs, you got land and buildings for these things. Then you're going to have your power systems, right, which are
Mhm.
causing a problem. We talked about this at Rebel Capitalist Live, saying the way to play AI was in energy. In the US, pretty much natural gas, which has worked, and different depending on the jurisdiction, right? Every sort of country has its own major electrical or energy system related to electricity. But these are all costs, fixed hard costs. And then, of course, you've got with the AI stuff, you have massive depreciation on these things. The chips are obsolete in 3 to 5 years,
That's my point. Yeah, that's my
and
point.
the other stuff lasts for about 10, you know? So
Yeah.
you got probably like a 10-year depreciation curve on a data center. And they're building these things now where, like, yeah, you're gonna have billions of dollars of depreciation, and then you look at that, you say, "Okay, that depreciation's fine," right? If you're generating, like, massive revenue, but they're not.
Yeah,
They're
right.
they're generating they're not generating enough revenue to cover just the depreciation, let alone margin expansion, reinvestment of capital, distribution to shareholders, none of that, none.
And that's
So,
charging $20 a month. And when they're in the future likely going to be able to charge $1 a month. Or, a
and
lot of people like Google will probably do it for free and
and
just try
and
to monetize through ads or something.
and I can see that there's actually no way out. Like, if you and I were running some AI company, we can't escape this. Why? Because the moment we look at it and go, "Hey, George, this isn't gonna work," and you go, "Yeah, Chris, this isn't gonna work," what are we gonna do? We'd have to stop. And the moment that we stop, the moment we're no longer in the race, right?
Yeah,
Because there's
yeah,
like 10 other guys and they're all fucking sprinting. So
yeah.
everyone's sprinting right now with this wild hope that they will be the first. And even if you are the first, again, this comes back to the dot-com era. Could we have in 2000, 2001 picked who the actual winners of the internet were going to be?
Yeah.
I couldn't.
And that's with network effects because,
Yeah.
now you have no network effect. Like what like we talked about that. What's the network effect of Gemini or Claude or there is none. So it's
Yeah.
at least in that time frame, some of those companies, like Facebook as an example, had the possibility of building a moat around their business. But now it seems like the moat is just either financial engineering or political favors or just the last man standing. So we're just going to incinerate cash as fast as we possibly can to hope in hopes that investors continue to give us more cash to incinerate than everyone else.
It's interesting because this is also sort of brings in like almost a geopolitical play. And a buddy of mine who actually mentored under Brad, Fergus Cullen, talked about this. And the play that seems to be being played right now is China is looking at all of this and they're saying, we just want to own the infrastructure. We're going to own the underlying. We're not going to try and compete necessarily on the high end tech side of things. And they're doing that across multiple industries, but they're definitely doing it in the AI space.
Mhm.
And so, and I and that's actually a much cheaper way to play it, right? You can own the underlying commodities that are required for
Oh,
the
right,
build out
right,
for cents, and like they're cheap because no one's really paying any attention to them. Nobody gives a shit about copper. No one cares about like any of this stuff. Electricity, whether it be nuclear, coal, whatever, they're not concerned about that. And even the actual components that go into it, they're more interested in that. But they're like saying, well, we're not going to try and fight the battle of competing with AI or competing on the AI front to the same degree. And I think that is, we will find out in, I guess, 10 years' time whether that was a smart decision. But I have a suspicion that they will be in a position to actually buy up a collapse.
okay, but that's assuming that the government doesn't step in like Trump and buy 50% of the company to go ahead and bail them out, similar to Intel or the rare earths. I think you were talking
But
about that as
then,
well.
yeah, but then that brings up another structural issue, which is with respect to the fact that the dollar supremacy, while it's still in it still exists, it is losing power, and we can see that in terms of foreign purchases of U.S. Treasuries relative to say something like gold, and that's been underway for some time now. So these sorts of things, it's like if you and I bailed out Johnny down the road, right? Because he cocked things up. It doesn't necessarily make us stronger, especially if you have a government taking over private sector stuff. Look, if governments operated better than the private sector, we'd already be communists. And so that's been tried and tested in the past, and it's been found wanting. So you're structurally making things less efficient by doing that, by going in and saying, oh, well, the government's going to step in and take over these companies and so on and so forth.
Well, I'm saying they might. I don't know if the release valve is the dollar there, because then if the argument is that we're creating more economic distortions, which I totally agree with, and therefore people are going to dump the dollar for, let's just say, something in China. China is doing it to a greater degree. I mean, they're completely bailing out their real estate market, which was the largest asset class in the world as of like 2 or 3 years ago. It was like 60 trillion. So I don't know if if Trump came in and, let's say, bailed out Nvidia by to the tune of like $1 trillion, I don't know that that really impacts the dollar too much. Although it does send a message to the market that the government's going to be a lot more involved, which is pretty much the whole message of the Trump administration up until this point. And
It's
so, at the very least, I think it sends a message that we're we're not just open for business, but we're only open for business if your business is crony capitalism.
Well, I guess we probably one of the best reference points would be looking at Japan, right? Where the Bank of Japan, they ended up owning chunks of ETFs and equities and everything, and we've now got 20 years of stagnation. So it's not broadly, well, it's definitely not positive for economic growth,
No,
despite whatever that might happen in the stock market price wise, because that can be affected by any number of different variables. Inflating the money supply, it will more accurately probably additional credit creation, but it's not good for economic growth. It's
no, that
stagnating. It's
that
stagnation.
the price is always paid by the poor and middle class. And I would argue that's exactly who paid the price in Japan. And where
Yeah.
I really started thinking about that was with Bill Fleckenstein. He did that thought experiment with Grant Williams. This was probably 4 or 5 years ago on their podcast, where he said, what if they just did a debt jubilee? The Bank of Japan
Mm,
and the government there, because they owned like 60% of the JGBs. So
yeah.
you're only dealing with two balance sheets. And he's like,
Mm,
would anyone even know? And I thought about that for like 2 weeks, and I'm like, no, no, if they didn't announce it, like,
you wouldn't know.
there's only two balance sheets. Like, there's there's no way anyone would know. So does that mean that they get a free lunch? And the answer is no, because the government spending that created those JGBs to begin with, that distorted the economy to the degree to which lowered the standard of living to the much, much lower than it otherwise would have been. So the price was paid by the Japanese citizens, even though the price might not have to be paid by the
Yeah. The
JGB
price
market.
doesn't necessarily need to change now. It's already the cost has been borne.
Yeah, I mean, if your growth is like this, and that's, broad proxy for the standard of living. If you're below trend or stagnation, to your point, where you're flatline for 30 or 40 years, I mean,
Yeah.
think of the growth you would have had and what the standard of living would have been. And that delta is the price that was paid by the government spending. And we're getting to the point now where it's my view, my base case is that the United States turns into Japan from a standpoint of stagnation. Now, is that stagnation more deflationary, disinflationary, or inflationary? That I don't know. My base case there over the next 10 or 15 years would probably be more inflationary, just because I think the government's going to do everything in their power, the central planners, to screw up supply chains and reduce the supply of goods and services, just like we saw during the cerveza sickness. And I wouldn't doubt if they came out with price controls and all these UBI and all these other schemes that will temporarily skyrocket the CPI and then lead to a big bust and then a big, like a roller coaster ride, very similar to what we saw in the 1940s, where in 47, the CPI was 19%. And 2 years later, in 49, it was -2. Hey guys, if you're watching this video right now, you probably know the stock market, the housing market, pretty much every market is in a massive bubble right now. The Fed is totally out of control and the debts are exploding. You know this doesn't end well, but the question is, what do you do about it? Well, fortunately, I've got the answer. Now, let me be clear. If you're the average retail investor just watching CNBC and trusting the system, this definitely is not for you. But if you've been sensing there's something wrong and you're looking for clarity through all of the chaos, then Rebel Capitalist Pro is your unfair advantage. What is Rebel Capitalist Pro? It's the private investment community that I have with my good friends Lynn Alden, Chris MacIntosh, Brent Johnson, Patrick Seresna, and Jason Hartman. It includes private member-only live stream Q&As that gives you direct access to the pros I just mentioned. Also, proprietary research from Lynn Alden and Chris MacIntosh, model portfolios, exclusive whiteboard videos, and best of all, the Rebel Capitalist Pro community. Rebel Capitalist Pro is basically the cheat code you need to not only protect your wealth, but to build wealth and thrive in this crazy world of asset bubbles, out of control central banks, and big government. So stop worrying about this stuff. Stop losing sleep and start investing with confidence. For more information about Rebel Capitalist Pro, we'll put a link in the description below this video.
But do you think the US would be able to do what Japan did, given that it has dollar hegemony?
In what, do what they did in what sense?
Like within Japan, I mean, they basically, like you say, yeah, the Bank of Japan started owning, tons of the equity market. They basically control the bond market. Like there's no, in fact, there's almost no bond traders in Japan anymore because
Yeah,
like,
I
what are
don't
you
know
going to
that the
trade?
US would have to. I don't know that the US would have to, because I don't think the Fed would be required to step in and buy the long end of the curve or any part of the Treasury market, because it's going to be predicated upon growth and inflation expectations. So, as an example, let's just say that nominal GDP in the United States was 4%. And let's just assume that we have all the foreigners dumping treasuries, and we have Scott Bessent coming out and issuing whatever, $10 trillion worth of treasuries over the next 2 years for deficit spending. And let's just say that the supply side of that drives up the yields on the 10-year treasury to whatever, 10%, right? When nominal growth in the United States is 4%. Well, who's not going to buy that?
Mm.
Like I would probably even buy that. Like even bond bears would probably buy that, and they're using their own money. But just think about the banks, right? Just think about the banks with their dollar funding costs are, let's say, 1.5%, and the 10-year treasury is trading at 10. They're just pocketing that
Yeah.
spread. I mean, they're going to buy that like it's going out of style, to the point where those yields are going to come back down more in line, not perfect, but more in line with nominal GDP. So I don't know that the Fed would be required to do that for anything other than psychological purposes. And then, lastly, I'd point out that when they usually do QE, interest rates usually go up, not down. Like
Mm.
QE 1, 2, and 3, interest rates went up. And
Yeah.
because you had more selling than the Fed buying, because growth and inflation expectations actually went up. So I don't know that the Fed, I'm not saying they wouldn't do QE. That's not what I'm saying. I'm saying I don't know that they would have to really control the long end of the curve. The long end of the curve is going to go up based on whatever's happening with inflation, not so much what's happening with foreign central banks dumping treasuries, or with Scott Bessent issuing due to the deficits.
Yeah. And then, of course, you've got, yeah, I mean, the thing in Japan was that I think to some degree they also managed to do what they did as a consequence of global interest rates falling all the time. So, like, you had this relative, there wasn't like an escape hatch to the same degree. If you were a Japanese investor, I mean, sure, there was some reason to like send money offshore and get a better yield outside of Japan, but yields were falling anyway. If you had a massive variance where yields were rising globally, and then the Bank of Japan was doing what you're doing, like, and you had no capital controls, you would have just sent your money offshore and just kept doing it. There's been no point in investing domestically, both in equities and in bonds, because the two landed up being quite closely tied together, and they landed up being quite tied together because the Bank of Japan is in control of both of them, just to a certain degree, certainly in the bond market, and then increasingly in the equity market. So,
Yeah, I mean, I think that illustrates my point that what's a much bigger driving factor is global growth and inflation. And let's just assume for a moment that during that time frame when the Bank of Japan was doing all this QE and taking 60% of the JGBs on the balance sheet, let's just assume during that time we had the inflation rate, in the United States and the domestic, or excuse me, the developed economies going from 3% to 4% to 9% to 10% to 11%. What would have happened to the long end of the Japanese curve? I can almost assure you, even with all that buying, the yields would not have gone down to whatever
That's what I
1%
mean.
or something like that.
I think
See,
they managed to do it in an environment that was globally conducive to them doing it.
yeah, I guess my point is, even if they wouldn't have done it, the yield still would have been the same. Like the yields, I don't think the Bank of Japan owning 60% of the market really impacted the yields that much. I'm sure it had some effect, right? But I don't think that if they wouldn't have bought 60% of the market, I don't think JGBs would have been trading at 8%, or, assuming that they were trading at like 1%. I don't think, maybe they would have been trading at 1.5 instead of 1%. But it would have followed the trend of global growth and inflation. So that's a much, much, much bigger driver. And therefore, I think that's where the focus should be, as opposed to the focus being on just deficits and debt.
Yeah. And I mean, just sidestepping a little bit here, I had a conversation yesterday with a client, and we were talking about, because he's from the UK, he's rightfully a little bit concerned about things taking place there, and because he spends a lot of time in Europe too. And when you're looking at Europe and the UK and this large block of capital, it's very hard to be bullish on it, right? And then when you look at capital around the world and where one could deploy it on scale, it actually makes you look at the US as somewhat favorable, right? Despite the fact that we've just talked about Nvidia and the Mag 7 and the S&P and everything else being being somewhat problematic. This is all just to say that you have all of these forces in place. So domestically in the US, we can make a judgment call that we don't necessarily want to be long the Mag 7 or the S&P for all the reasons we've alluded to.
Right.
But then when you look at kind of globally, you go, what if you're a European? Do you invest in the DAX and in the FTSE and like, what do you do? And aside from valuations, which are actually much better, at least from a valuation perspective, there's all these other macro factors which are really disturbing, like
Mhm.
unbelievably disturbing,
Yeah.
which it makes it very difficult for one to deploy capital. And so then you go, well, what are your options? Like, so the S&P then becomes, or the Dow becomes a relatively better bet than owning, say, the FTSE or UK equities.
Yeah.
And so you kind of have all of these forces around the world. And I think probably the first shoe to fall is actually going to be in the UK or in Europe, potentially France, which is why they're all driving towards war. And of course, a war economy is not going to be particularly good for European equities, right? The US is going to be seen to be a safe haven in that kind of environment. And so these are other forces. Now I'm almost like playing devil's advocate to the, hey, you shouldn't be long the S&P, which I still maintain. But what I'm saying is that there are forces there that can continue to push capital into the US markets. So I wouldn't be going out and shorting them right now. I think
Yeah.
it's too dangerous to do that, despite the fact that we're seeing frauds in the AI space, despite the fact that we know that the data centers are extremely expensive, cannot actually be funded, and so on and so forth. There are these other forces in play. And I think this is where we like to hide out in just deep undervalued equities, and we do it globally. Like, we're not tied into the US in particular. I mean, we're finding things in emerging markets with super low PEs. Greek equities was just one example. That's an easy one to talk about because you just say Greek. It's not a particular company in a particular sector. But
Yeah.
I think this is a time where people need to be super cautious.
I think that's the key. So if you said, George, you only have three options. You can either invest in the S&P, you can invest in an index fund in Europe, or you can invest in an index fund in whatever, Japan. Yeah, I'm probably choosing the United States, but fortunately, the world of investment opportunities and asset classes is a lot bigger than just those three options. So, given that it is much bigger, I would way rather be in the GDXJ than the United States stock market or the European stock market or the Japanese stock market or for the bond market for that matter. Most people think that when I talk about kind of the mechanics behind the debt, and I always say, the deficits and the debt don't matter as much as growth and inflation expectations. They always think that makes me a bond bull. The George is just eternally bullish on bonds. No. That's not it. That's not it. In the short run, I'm kind of bullish, but longer run, definitely not. It's just what I'm talking about is the back end mechanics that drive the yields, not necessarily my prediction of the yields themselves.
Yeah.
But again, the whole point there is in this type of environment, you can't just throw a dart and expect to win. Like you've got to actually do some homework. You got to do some research. And when you do that, then you can find some fantastic opportunities where the risk reward makes way more sense than even the US stock market, let's say, compared to the European stock market or the US bond market, the Treasury market for that matter. Chris, let's go over a specific equity that you've been talking about. And I just to illustrate this type of framework that you use, I'd like to go over kind of your rationale. What brought this onto your radar? Why did you buy? What was the rationale? And then I think this is one that you might have sold. So then why did you go ahead and sell? So let me do a screen share. I think we've got this up. So Chris, this is a stock that I believe you owned in some of your funds, and you were talking about it in Rebel Capitalist Pro, which is why I know about it. And it is Rockhopper, and I don't know what it is now. This chart's a little old, but as of about a week or two ago, it was up 223% in 2025. So obviously massive outperformance relative to the S&P 500. But this is one where in addition to the upside reward being a lot greater, the downside risk was probably a lot less as well. So can you tell us the story behind Rockhopper?
So, I mean, this comes back to looking for unloved, hated sort of sectors in this environment because all the capital is just getting poured increasingly into large equities. And this is something, again, we just alluded earlier to Michael Green and the fact that you have all this passive capital flows. So what that means is that if you have $1 billion under management or a couple of billion under management and you're deploying, let's just say for shits and giggles, 5% of your capital into one particular equity, you're not going to be able to buy this company. Okay. Right. The market cap on Rockhopper right now is probably about 480 million. And so it trades in London, so that's sterling. So call it $600 million. Okay.
And that's now, let alone where
and
it
that's
was.
now. It's now exactly.
Yeah.
And so you would be you'll be buying into a company with a few $100 million market cap, right? So this is untouchable for the vast majority of where capital is being deployed now, and that's as a consequence of this huge amount of passive capital flows. For people who aren't familiar with it, I know you've talked to Michael about this before. I'd suggest people go and look up your YouTube videos with him, but to get a better understanding of what that looks like and why it's important. And why it's important for us is that we like to dig where there is less risk. So if I'm worried about passive capital flows, I can take advantage of that by virtue of the fact that I can look where those passive capital flows cannot go. Okay, because at some point they can turn around, and
Right.
they will turn around. Like that's a given. It's just a matter of when. It could be a recession. It could be AI taking people. The irony is that it could be AI taking people's jobs, and they've been sending their money into Nvidia. That would be ironic.
That makes the net inflows go to net outflows.
Exactly. So, but back to Rockhopper. So Rockhopper is an oil and gas exploration company. They actually got stuff in the Falkland Islands, and they were a trade amongst many others. And that's another important concept: is that we're not stock specific per se. We like sectors where you have an entire sector that is representative of value. It allows for a much, much lower risk profile for us. We can have
Mhm.
tolerance of risk when you've got an in sector and we go and buy 5, 10 companies in that sector, all of which represent deep value to us and asymmetry. And what it means is that we can buy something, for example, like Rockhopper sitting in where they got operations in the Falklands, and then we can go and buy another company that's got operations in Argentina, and then
Right.
another one that has got operations in Canada, and so on and so forth.
But it's the same macro view, and it's the same,
Exactly. But
the same macro view, but then the same bottoms up strategy once you've got the macro view, being that it's cheap.
correct, correct. And so then it's a matter of just looking at balance sheets, looking at the valuations on these companies. So these, I can't remember exactly what we bought this on the PE. It would have been sub 10, and then in a space where you're getting margin expansion. So we're often looking for that where companies are actually they're profitable, they're doing well, but the market's just not really doesn't really
Yeah.
care or
I know
doesn't believe in the story or so on and so forth. So
I
we're
know you're
seeing a lot of
talking about Rebel Capitalist Pro and, like, I
that.
think it was, like, your January or February newsletter. You were talking about it, something like that. But then
Yeah.
you said you sold recently, right?
So this is another interesting thing. People often say, "When do you sell?" There's a number of reasons why you might sell something. For the vast majority of the time, we'll end up selling not necessarily as a consequence of something particular in the company or even in the sector. Often we'll end up offloading as a consequence of finding value elsewhere. Things
Ah,
are relative.
right.
So we will look and say, okay, we own this. It's gone up to 300%, whatever it is. So now there's two things. One is portfolio positioning. Okay. We don't want to be overly exposed to any one thing. We want to have multiple irons in the fire, all of which represent asymmetry for us. Okay.
Mhm.
Now, let's just say we've got a deployment of, for ease of numbers, let's say 10 different sectors, 10% position sizing. Okay. Let's say one of that 10% was Rockhopper and its mates. And now that's 20% of the portfolio or 30% of the portfolio, right? So now we have a concentration of capital risk in this sector. Okay. We might still like the sector and often we'll let certain things run, but we can pare back some of that if there is something else that represents equal or better value. We might look at
Mm.
Greek equities. In this instance, I can't remember exactly. I suspect this was where we landed up transitioning. We started buying Chinese equities.
All
So
right.
which have done quite well over the last 6 months. Chinese equities largely because they got hated. Everyone thought that Trump was going to do what he did to Russia, yada, yada, yada. There's a whole lot of reasons why Chinese equities became unbelievably cheap. And so we looked at those. We're like, these are literally better than Rockhopper at 3x what we bought it at. Okay.
Mhm.
So it's not necessarily that we didn't like Rockhopper or its mates. It's that there was something else that represented a better risk reward for us. And so then we can either take all of that capital or some of that capital and redeploy accordingly. And we just keep doing that, constantly keep doing that. And so it's often not a situation where you're saying, oh, this is now, we think this is going to burst or anything else
Right,
like that.
right.
And what it often transpires is we'll buy things, they'll do kind of what we anticipate they're going to do. We will offload some or all of it, and they'll continue to go higher. And often I'll get it. People say, why did you sell that? It's gone up another 50% or whatever it is. And that's the reason is it's a portfolio management positioning as well as relative looking for relative value elsewhere. And I
Mm.
think it's as though from a mental standpoint for people, if you're constantly looking for those opportunities, it's easier to not get wedded to what you already own. And that's a big risk that people often I see. They'll buy something, it treats them well, and they fall in love with it
Mm.
and they
Yeah.
don't want to get rid of it. Oh, but it's done so well for me. And then so they'll end up justifying because it's paid them, they'll end up looking for validation as to why they should own it. I prefer not to look for that. I prefer to look for other value. And then it's a relative basis where I can make that decision. And I don't then feel tied to whatever I've owned, even if it's done well for me. So I think that's kind of quite a good mental exercise for people to go through, because it's the biggest risk, and Rick Rule has mentioned this before, the biggest risk to investing is what's between your own two ears, right?
Right.
And it's that mental
So
game. So
true. Yeah.
so that's often when we'll end up selling something, is for those two reasons.
That makes a lot of sense. But to be clear, if let's just assume you were still in Rockhopper, if you still like Rockhopper, the trend looks good, and there's nothing else that you can find at the time that would be better, you still stay in it. The catalyst for you selling is you found an opportunity where you thought the risk reward was even better.
Correct. Of course, if there is something in that space where it's like you just start seeing bubblicious or quasi-bubblicious sort of behavior, and the valuation, like all the normal metrics, right?
Yeah,
If your PE ratio start running into the 20s or something, and like,
yeah, but then you
um,
wouldn't like the risk reward. So like
no,
I'm thinking about it in terms of like GDXJ because I own a lot of GDXJ. And fortunately I was able to buy at like I think I bought it like $68 or something like that. So it's really gone up to a point where I'm probably up, let's just say 50% or something like that. So in my mind, as a human, you're hardwired to want to sell to realize that gain because you're like, I'm way up. I've made all this money. I don't want to lose the money when I have to keep reminding myself that the reasons for me buying have not changed. And the reasons for me buying have actually gotten better. Like there's a better argument, I think, for owning it now, or just as good of an argument as there was when it was at $68. Because, like what we were saying earlier, the valuations and the underlying companies still make a hell of a lot of sense. And by the way, this is one thing I don't hear too many people talk about because, and I've been the first person to point out that if you do have a liquidity crisis, it very well brings gold down with it because gold is the only thing that has a bid. But let's just say that you get a .com blow up where you kind of get a balance sheet recession. I actually think that would be extremely good for the gold miners because in that scenario, you don't have that liquidity event where everyone is selling gold. You have people probably buying gold because they don't want any more counterparty risk, which is I think why it's run up so much as it has. In addition to that, you most likely have diesel prices going down, if not temporarily. And as I understand it, diesel is like the number one input cost for a gold miner. So you could have a scenario where gold is going higher and their input costs are going lower. Their margins are expanding even in a balance sheet type recession environment like we had during the .com bust. So anyway, the point there is that I haven't sold because I just keep looking at it and I'm like, the reasons haven't changed. And then, in addition to that, every single time I talk to a guy that's in the gold space that owns like a gold dealer or something like that, they're
oh,
always
very.
telling me that retail are still net sellers.
Mm,
So retail
yeah.
is not participating in this huge move up. You look at the chart, you look at the trend. So that's me just kind of thinking out loud as to why I haven't sold the GDXJ position, even though it's up, whatever, 50%.
The other thing is when you go through if we have, and I think we are if you go through these capital rotation type cycles, they're not like 1-2 year cycles. They last
Yeah,
for like 10
exactly.
years.
Yeah.
Now, within that, you can have severe pullbacks, right? You can have a 30, 40, 50% pullback, but you've got to decide ahead of time how you're going to deal with that. Are you going to try and trade it? Are you
Mhm.
just going to hold your position? Or are you going to do both? Are you going to have like a portfolio that you sit here and you go, that's your buy, that's your investor, shall we say, portfolio, and then your trading portfolio? It's difficult to wear two hats, I would say, but some people do, and they'll trade around positions. But I think it's important to actually get that mental framework ahead of time, like
Yeah.
literally now,
Yeah. Yeah.
because otherwise you start getting swayed by the market price, right?
Mhm.
And the emotions that come with that. You're like, oh, I'm up this much, and I've just made a blah, whatever, over the last week, or oh shit, I'm down, and you start getting you become a victim of the market as opposed to being in control. And that's the biggest risk, I think, for most retail investors, is that lack of sophistication to be able to mentally deal with that. So
Yeah.
you need, so if you understand that you're of the belief that you're going to go through a capital rotation type of cycle, and that you're going to have a multi-year bull trend, then you just need to decide how you're going to deal with that, right? So you just buy GDX and you say, I'm going to look at it in 2 years' time, go to the beach, and I'll
Mm,
see what's happening. And for the most part, if you look through history, that's the right thing to do. you
yeah.
know, and the other thing that I'll point out is there's a famous investor by the name of Howard Marks who runs Oak Tree Capital. I really like reading his missives, and he's a legend in the space. And he talks famously about things like trying to identify the future. And he's like, I don't really try and identify the future. He says, what I can do is I can know what's cheap and what's expensive,
Yeah.
right?
Yeah.
And that's what he does. He's like, if it's cheap, I'll buy it and I'll stay away from what's expensive. And it sounds so simple, but it's so difficult for most people to do it because they get caught up in the news flow, or they get caught up in this is happening, or Trump's invading Venezuela, or Nvidia is going to do this or that, or there's all tons of noise. And for the most part, a guy like Howard Marks just sits in and he goes, what's cheap?
Yeah. Greek
What's
stock
expensive?
market. And nobody's talking about it.
Yeah.
And oh, by the way, it's up more than the Nasdaq in the last 5 years.
So when you do that, you can still then look at all these other machinations and see whether you think this is happening or that's happening. But like your base scenario should just be like, what's cheap,
Yeah. Right.
and start from that. Oh, this is cheap, and then you're like, why is that cheap? Maybe there's a really valid reason, and I don't know, the country's going to get invaded or whatever the case might be. But you start with that as a premise, and you're like way ahead of most people, because most people, what most people start with? They start with narrative,
No, they start with price. Oh, yeah, price and narrative.
narrative
They
and/or
ask
price.
themselves, "What's the price gonna do?" Which is
Yeah,
completely unknowable, and the only
yeah.
thing that's knowable, and that we say this all the time on this channel, and it sounds like, the gentleman from Oak Tree has the same framework, where, knowing the price direction, nobody can guess that, nobody knows that. The only thing that is knowable is it cheap or is it expensive? And then maybe if you wanna get sophisticated, is there a catalyst?
Pretty
Yeah.
much, pretty much. And you know, it's gone back to that sort of intrinsic value, what I talked about before, which is that ultimately an asset which is what you're buying. An asset should have some earning power, and that should determine its ultimate value, right?
Yeah.
You
Yeah.
you buy a house and an apartment there in Medellin, and you rent it out. Like, when you're buying it, you're going, what's its earning power? Like,
Yeah.
how much do I earn on this thing? And so when you have the disconnect between the earning power and the asset, that's when things get risky, which is why Nvidia makes no fucking sense whatsoever.
Yeah, there you go. There you go. All right. Well, buddy, thanks a lot for the conversation. If you guys want more strategies and techniques and live streams, just like this, not this is a live stream, but videos, you can check out Rebel Capitalist Pro. Chris is one of my business partners there with Lynn Alden. And this is exactly what we help investors with, is this type of mentorship, but really seeing the signal through all of the noise, and hopefully helping just normal retail investors, the average Joe and Jane, make better decisions with their portfolios so they can, and not just outperform, but have better kind of risk reward. So anyway, we'll put a link in the description below if you want to find out more about that. Chris, thanks a lot, buddy. I mean, we were only
Been a
going to
pleasure.
talk for like 20 minutes, and I can see we went on longer than an hour, which is what we usually do, right?
Exactly. That's all good.
All right,
Been a
buddy. Have
pleasure.
a good one, and we'll talk to you soon.